Vikas Khemani is with us. He's a market master of the day, founder at Carnelian Asset Management and advisors. Vikas, great to have you with us here. Thank you very much. You know, this US-India bit, I was just, the way I was framing it was one step closer, looks like. Or maybe the equity market is already starting to pick some of this up. FI selling has, stopped a small buying here and there. And you've got, Prime Minister Modi, President Trump speaking last evening, Treasury Secretary in the US saying, well, India is going to buy more US oil rather than Russian oil. What's your sense, Vikas? The question really is that meaningful for markets whenever that gets resolved? And in what way?
Hi, Prashant, good morning. I think, US tariff uncertainty has been long talked about, and I think we all know that it is not very significant from an economic impact perspective. But having said that, you do not want any disruption in the US-India trade relationship because both economies are very, very important to each other. And I think there is a by and large major conviction within the market participants in general that in due course of the time it will be sorted out. I don't think the continuation of 50% tariff is going to go for long. And I think it's good that we are making strides in that direction. But throughout this uncertainty of last 4 or 5 months, we have continuously said that what RBI governor is doing is far more important than what Trump is doing, in the sense that, if you see our regulator has taken far, far more growth-oriented policies, right from cutting the repo rate to infusing liquidity in the system to, last week's policy of where the huge reforms happened or the relaxation happened to boost the credit growth. So all those things are far more important. And if you see from government side, whether it was income tax cut, GST cut, spending on the infrastructure, everything is going well. So when your government as well as the regulator are clearly, taking a lot of growth oriented policies, it is only a matter of time that it will reflect. We've been kind of quite positive on the entire corporate earnings cycle. We've said that, in next sort of second half of this year, you will see good corporate earning picking up. Now, so you have a good setup going on right now. As the clarity comes around, whether it is corporate earnings or tariff-related issues or anything else, I think market will keep inching up towards, as the uncertainty settles down. That's been our broad sort of approach towards the market. Regarding your questions on FI selling, I think I have long said that it has nothing to do with the trade deal or this and that. I think, India is a part of emerging market basket. Whenever Fed raises interest rates, the investors in US and elsewhere pull out money from the emerging markets. And that was happening since post-COVID when the Fed started raising rates. As far as and in that period, India was significantly overweight because China was not doing well. And in 24 and early part of 25, as the China weight started going up, obviously India became whatever, you have to sort of sell India to get the China weight. So now as the Fed rates are coming down, beginning of that has happened. I do believe that we will start seeing a significant flow coming through from FIs as well. So I see good liquidity happening. I see good corporate earning happening. And as some of these talked about uncertainty settles down, you will see market holding on that.
Yesterday, one of our experts, Vikas, said that, tariffs are temporary, but the GST cuts, the RBI policy, that's permanent. So just echoing what you're saying. But are you comfortable buying India's new age platform companies? Because as you have been talking about to your investors in your letters, that the fad FOMO phase seems to be over and companies are now cognizant that they need to focus on the profitability, the fundamentals, rather than just chasing growth. So the question is that, this narrative is now playing out, profitability over just, crazy growth, frenzied growth. But are valuations comfortable to buy, say, a basket of new age platform companies now?
Very good question. See, if you see when they hit the market in 2021, I think they were largely driven by the, very big, fad. I think more they burnt money, more probably valuation they got from the market. And most people, and I think it was yet to be proven how they will scale up and all those things. But in the last 3-4 years, that burning to earning kind of change has happened. Most platforms are focusing on sort of reducing the burn and get to the operating leverage and, build a sustainable model. And I think that is what markets like now. There's no denial on the fact that, platforms are good play. And we've always said that we never had earlier complained with the platforms play and neither now. I think because they have a high operating leverage, it requires a lot of effort to build those platforms, and they are serving a specific need of their segment, whether it is Paytm to any platform you look at, right? So I think they bring lots of operating leverage and scalability without so I think that you will see. So we like the whole space, and when I'm saying whole space does not mean we like all the companies within that space. We don't kind of understand many of them. So as long as we understand that there's a moat behind the platform, there's less risk of disruption, competition is less, and platforms can scale up from here in next 5-10 years. Those are the platforms to bet, and you can't, value them in the conventional valuation methodology. So, and there's no right or wrong sort of number for that. So you try and understand, what could be the operating leverage, what could be the outcomes in next 4 or 5 years, and then try to understand from that perspective.
Right. From here on, if you had to bet on one particular theme over the next 12 to 18 months, which one would that be? And on the other side, what's a place that you would not want to put your money in?
I think given the fact that RBI gave significant relaxation on the credit growth, I do believe that credit growth will pick up significantly or in a meaningful manner. So you will see banks doing pretty well. Again, investment cycle has done continues to remain robust. So look at companies like L&T and Allied Pack, which has kind of done well, and those are the businesses which, in my opinion, are still significantly sort of undervalued. Consumer seems to be, especially in the discretionary side, there is a good demand happening, and with the interest rates coming down and tax rate cut happening, it also acts as a demand booster. So I think these are the 2-3 packs which will do well. And having said that, of course, you have to identify right company which can benefit from that. But generally, broadly speaking, these are the three broad segments will do well.
And what would you avoid?
Avoid, I think, generally speaking, see, at most, I would avoid hype stock. I would avoid where there's no risk reward, one understands. So, that's a general thing, but I'm not like per se negative. And if there's such a widespread growth happening, you would not want to sort of, call out negative on any segment. But within each segment, when broad-based growth is there, within each segment, there are hypes which gets created, and one should definitely avoid. I'm also not as sold as on consumer staples because they are significantly higher. They're better risk reward trades, not because, they are not good companies, but they're better risk reward investment elsewhere, given their valuations and growth profile.
Vikas, yesterday, not talking stocks or anything, but in terms of business line, TCS said they're going to invest in a data center, 1 gigawatt over 5 to 7 years. Could be $7-8 billion in investment. Not about TCS, but about that line of business. Have you looked at it? And where is the value? There is there's a lot of stuff which goes into it, right? There's racks and servers and power lines and chillers and cooling and concrete. Where is value? What should one look at? Which area?
See, there's no denial that data center is a very big opportunity in next 1 decade or so. And I'm sure lots of capacity will come. So I think our view has been that direct players are very limited, and like similar point that because it is a sought after segment, I think valuations are, or you don't understand how they are kind of being considered. So I think, enabling sectors, there are many, and it's not only with respect to data center, but, whether it is cables, whether it is, I think there are lots of, enabling segments which can play with that, but they will not be pure play data center play. There will be allied plays as well, because what you supply to data center, all those companies also do work with many other companies as well. So I think somewhere, this also acts as additional growth for the company operating those enabling space.
Because broadly, if we see more IT companies making a play on the AI ecosystem, even though there is no direct synergy. So for instance, just for the sake of an example, TCS making that investment in AI data center. So there is no synergy which comes from an IT services companies. But we've also been complaining, on the other hand, that these companies cash rich and they've been making unproductive. The deployment of capital has been unproductive. So if we see more companies making such bets, should investors cheer that, or would you be skeptical because it will alter the free cash flow, the returns, the ROCE will be lower than the existing business?
I'm sure, they are going to make this over a long period of time. So it's not that they're making $7 billion investment in a year, but given their cash flows, I think some kind of, is fine. And it's not completely unrelated. Of course, it is different business, but it's not completely unrelated. Maybe there are certain synergies also they see. So I would look at, according in that direction. But I think as far as the IT sector is concerned, I think all companies have to get ready for, AI and related technologies, because as the demand is shifting on the direction, and companies which do enable or get ready faster will be the future winners. But yes, like every time there's a technology transition happens, not necessarily yesteryears companies do well in the future. For example, if you see Y2K time, Infosys, Wipro, Satyam, sort of winners. After 2009, when digitization, cloud migration, the theme came, HCL Tech, Persistent, LTTI, LTTS, Mindtree, all those companies kind of scaled up very well significantly, some of them even 20, 30, 40x. So I'm quite sure that this cycle as well, you will find new companies which will become very, very, large future winner, which are today might be small. In the real opportunity, if you ask me, in IT space lies in those small spaces, segments where you can see companies becoming 20, 40, 50x.
All right, Vikas, always a pleasure speaking with you. Thank you so much for giving your insights, and wish you happy festivities. Obviously, we will speak to you more as we move towards the festival end of the year. The market